All right, while stock's recent losing streak may be blamed on negative news from around the world, our first guest actually believes that the markets are just flat out simply bored. Joining us now is Keith Springer, president of Springer Financial Advisors and author of Facing Goliath, How to Triumph in the Dangerous Markets Ahead. So, Keith, how can we be bored in an environment where we're seeing housing down, troubles happening in Greece, emerging markets seemingly starting to let off some steam, economic data and going in every which way, and the markets going up and down? How can we be bored in this type of environment?
Well, Shabani, the market needs earnings to move. That's essentially what moves stocks. Right now, it's bored because all the news is old news. I actually view this as a positive. The market typically doesn't discount the same news twice, meaning it doesn't go down on the same news twice. And almost all the news out there is old. We've known about Greece and the European mess. We know about Japan. We know about the weather in this country. We know that economic numbers are not going to be good. What we need is some earnings, and that's not for about 2-3 more weeks. That's what's going to push the stock market higher next. That's what's going to make a difference. Right now, we're in the summer doldrums. There's really no news but old news, so that's what the market is grabbing hold of. But, Keith, virtually every expert that we've had on over the last couple of weeks are also talking about earnings in the second half of this year being a growth spurt period for the markets. But then today, the IMF said that we're actually not going to see the economy expand this year. It's going to happen until next year. It's not going to happen until next year. Is there a chance we could be predicting this all wrong? Well, there's always that chance, but I think earnings, remember, there's an earnings lag. We had the QE money coming in the last couple of years. There's a lag. There was a lag for the benefit. There's going to be a lag for the earnings. Earnings are probably going to be much better than expected next quarter, and maybe even one more quarter after that. But definitely, you're going to see growth, not only in this country, around the world, slow down. I talk about it extensively in the book, and that's the whole point is we've got to identify and understand where we are in this economy so we know what to predict. Growth is going to slow. Demand is going to stay weak. The government is trying to create artificial demand with stimulus. Eventually, they've got to pull it back. We know we have an election year. They're going to keep fighting it with everything they can. But for the time being, earnings is what's going to move stocks, and stocks are probably going to do pretty well maybe in the next 3, 6, maybe even 9 months. After that, I really start to worry. Most importantly, let's face it, we have an election. They say there's no influence, but they're not going to want the economy to fall apart much before the election. Yeah. So I think they're going to buoy it up until that point. But for the time being, at least in the short term, earnings should be pretty good.
Keith, I've kind of gotten used to the idea of earnings being, quote unquote, pretty good, to your point. It seems like the market's grappling for something else. Now, you talked about, some sort of accommodation. Really, what does Wall Street want from the Federal Reserve? Because to me, that seems like the big overhang right now. Will there be a QE3, and is that the right medicine, at least for the stock market?
Well, for the stock market, absolutely, Charles. That's exactly what they want. That's what they're screaming for. They screamed for it after QE1, and they brought the stock market down 16%. The stock market loves the free money. It's addicted to the free money, and they think there's going to be more to come. You had Larry Summers come on just Monday saying that we need more stimulus or we're going to fall back. I think you're going to see more and more. I don't know if you'll call it QE3. I'm calling what we have now QE mini-me, which is essentially the continuation of the bond purchases and the money coming through and the maturities and the interest. There's going to be something, the continuation of the low interest rate environment with that language. You're going to continue to see something, and I think you're going to see more aggressive measures.
Keith, hold on, let me cut you off because we're running out of time. $600 billion is a mini accommodation. Before we let you go, you talked about the market being bored. There's an old saying on Wall Street, you never short a bored market. Obviously, anyone who's shorted this market is making money. Can't there be something legitimate, some real fear beneath the surface of all the things that we know that no one's really touching on?
Yeah, absolutely. And that's what always makes it a major concern is there's something out there we don't know. We already know about everything that's in the headlines, and that's not what's going to bring the market down longer term. That's what gives it corrections. Charles, that's a good question. That's why we have the correction. But the negatives are not that bad. With all that we know, the market should be down a heck of a lot more. I think we're in a pretty good shape. I see some positives in these negatives, and I see the market actually in pretty good shape for right now. Wow, that is impressive. We got a mini-me QE, and things are looking pretty good. We're going to bring you on the next time when we need to bounce off some bears off of you, Keith Springer, because you certainly bring some sunshine into our views today. Thank you very much. Thank you for having me.
All right, Keith.